Hi everyone and welcome to Inderes TV. Today we're going to talk about Scanfil, and that's why Antti Viljakainen is here. Hi.
Hello, Lisa.
I'm going to talk about the Q3, and the revenue increased by 10%. How much of it was organic and how much came from M&As?
Some 5% points of that growth came still from SRX acquisition. This was basically last quartile. This particular acquisition increased revenue inorganically. So the rest 5% were like organic growth, but there was also currency headwind of some 3%. So currency adjusted organic growth was something like 8%, which was like a clear uptake from previous quarters, and it was some time ago when Scanfil actually grew organically.
Yeah, so that's good news.
Yeah, it is.
Yeah.
It's clearly a step change.
Okay. In terms of cash flow, you wrote that Q3 was relatively weaker for Scanfil. What's behind this?
Well, usually in EMS business, the companies tie net working capital when top line grows.
Yeah.
So basically, cash flow was like constrained by organic growth, but it's like a positive problem in the big picture.
Yeah, so for these types of companies, that's a positive problem.
Yeah. It's it's much better to take a bit like buying capital to in VC rather than having a weak growth.
Yeah. So Scanfil has made two major acquisitions recently. What does the balance sheet look like?
Well, actually, these acquisitions are not yet completed. This ADCO acquisition was supposed to be completed at the end of Q3, but it's a bit late. It has not materialized yet. And the other one, the bigger one, MB acquisition in Italy, was scheduled to be completed during Q4. So these acquisitions are not yet visible in Scanfil's balance sheet reported at the end of Q3. But when we go forward to Q4, I expect that these acquisitions will be completed, and it will increase to some extent Scanfil's net debt. But the company had like a really strong balance sheet before these acquisitions, so it's still on a very solid level. I would assume that net debt to EBITDA ratio will be somewhere between 1 and 1.5, and the company has like a financial target to keep net debt EBITDA ratio below 1.5, so it's still very solid.
Solid ground.
Yeah.
So the company sold new projects for, I think it was 72 million euros, which was more than 30% higher than the comparison period. What type of projects are these, and how long will it take before it converts into revenue?
There are like projects to basically all customer segments that Scanfil has. In Q3, they sold like one big project to logistics sector, which increased year on year sales of new products clearly, but it's very difficult to estimate how much time it takes for these to convert into revenue. Scanfil has been reporting quite a long time, quite impressive figures on new project sales, but only in Q3 revenue began to grow organically. So it might take time, some 6 to even 18 months to ramp up these revenues. So I don't expect very fast growth from the company in near future because of these new projects, but rather I would say more like steady increase in top line.
Okay. From where will Scanfil's growth come from in the future? Will there be more M&As to come, or will it be mostly organic?
I would assume both. M&A remains high on the company's radar in this consolidating industry, but in short term it might be the case that Scanfil has to digest these two acquisitions before making any new M&A in 2026, even if balance sheet is still solid. But thinking about medium term, Scanfil will medium term and long term, Scanfil will definitely continue to do M&A. And then secondly, the EMS market is expected to grow also organically, and it's like a second driver for the growth. And as said, the company has reported quite positive figures on new project sales, so there should be also some revenue that is actually sold but not visible in growth yet.
Yeah. So what about our valuation and recommendation?
I think that currently Scanfil is pretty fairly valued. The share price has increased this year quite notably, and it has the appreciation has mostly come from multiple expansion, as profit growth has been so far quite limited this year, I would say. So as we speak, Scanfil is trading above 15 times its reported earnings, I mean PE multiple, which I consider quite fair for the company, since there is a good opportunity to grow earnings next year, so the multiple will decline the next year, but the profit growth is, and at least its magnitude is still somewhat uncertain. And my share price is very close to my DCF value as well. On the relative terms, Scanfil is still cheap, but on the other hand, peer group has become very expensive, at least compared to its long-term average. So I'm not ready to bank on the assumption that it's Scanfil share price that grabs the peer group level.
Okay. So the recommendation is?
We are on reduced recommendation, as I think that the share is more or less fairly valued at this stage.
Yes, fairly valued. Thank you, Antti, so much for all these comments.
Thank you.
And if you want to know more, go to inderes.se, and if you want to have some question for Antti about the Scanfil, then you can sign into our forum.